Halloween, great time for costumes and candy, right? But it may be a perfect time to look at those investments. Local financial professional Mark Triplett is here to talk about how it impacts the stock market. So, Halloween effect, this is really interesting. I didn't think about it until you put it on our radar. What is that?
So the Halloween effect is an investment strategy based on a theory that stocks do better during the winter months than they do during the summer months. And there's some evidence to support that. Some of your listeners might have heard the saying, "Sell in May and go away." That indicates that in the winter months, beginning at the end of October, is a good time to invest because historically the stock market has done a little bit better. In fact, one recent study showed that over the last 50 years, the 6-month returns were about 4% higher between November and April versus May through October.
And then what can we expect this fall?
Well, September has been the worst month for stock market on average, but October has a really bad reputation as well. The two biggest stock market crashes happened in October. But with inflation kind of peeling off a little bit, we've seen that taper off. The Fed may be slowing their rate hikes. We might see another one in November. That's still kind of up in the air. But historically, the fourth quarter has been really, really good for the market. If we look back over the last 50 years, the market has been up 80% of the time with an average of 4.2% in the fourth quarter. So this might be a really good time to maybe relook at your portfolio and stay the course, even though we've had kind of a nasty September and October.
Right. What should investors be doing with their money when the seasons do change?
Well, three things we tell all of the folks that we serve to do. Number one, assess your risk. Those who are in or near retirement, really begin to insulate yourself from stock market risk. Risk tolerance and risk capacity are two very different things, and it's important to understand what both of those are and how to make sure that you're well positioned. Diversify against investment risk, meaning own more than one stock, but mitigate yourself from market risk by understanding what the purpose of every dollar is and the timeline so you can determine where that money should be invested. And then have a plan. Really understand that a solid financial plan should really take into account your lifestyle, adjusted for taxes, inflation, and healthcare, and then really positioning your assets so that they're able to support you throughout your retirement years. And lastly, know what you can control. We can plan for Wall Street's turbulence, but we cannot control it. And the best we can do is to have a plan that allows us to absorb those stock market shocks, and so that we're not forced to sell into a panic. And a financial professional can be a really good person to hold your hand during those scary times and make sure that you don't fall prey to human emotion.
Thorough analysis. The first thing that came into my mind was I was like, well, do you invest in a candy company or a costume company? Because, sales are going to go up. So my mind was like Halloween effect. I'm sure that's what it is, but very interesting insight. Thank you so much for joining us on this Tuesday. Happy Halloween to you.
Thank you for having me. Happy Halloween to you too.